Welcome to the podcast today. My good friend Conor. He is the co-founder and COO of USDAI. Unfamiliar with that. Maybe they think it's like, is that a stable coin? What is this? Tell them what your product is and what you guys are hoping to build.
Yeah, thanks for having me, Jax. So USDAI is a synthetic dollar. You can think of it as like a high yield bond index. And we basically pair real world infrastructure assets as collateral. And then we take each of these individual loans and roll them up into this synthetic dollar product. And then that single yield bearing token, which is USDAI, can proliferate throughout the rest of DeFi, and you can borrow lend against that and, swap and do whatever with it.
Now we have some people on the pod that listen that know just about gaming, or maybe they're a little bit more in the decentralized AI space. And they're like, why do they need a, synthetic, stable coin that has yield associated with it? They're like, I've got USDC and I've got Tether. Why do I need this?
Yeah. So the way I think about the DeFi space is you have a number of different yield oriented products, and all of those really are going to earn yield from various crypto correlated assets. So, Athena is the basis trade that's longs spot and short perp on Bitcoin and Ethereum and other things. And all of these products are correlated to the price of crypto. So when the yields are good, that's because there's a lot of trading volume, but it's never kind of a uncorrelated to crypto, just flat yields. And that's really what you get with a RWA oriented product, is uncorrelated yields to the rest of crypto. Now, the key benefit for USDAI versus other kind of RWA oriented products is that the USDAI you can think of USDAI as like two pieces. You have a primary origination market, which is tokenizing physical hardware assets and then originating loans against those assets, and then rolling that up into this yield bearing token. And so the benefit of having kind of uncorrelated yields to the rest of crypto is, regardless of what's happening in the crypto markets, you're earning kind of mid-teens yield profile, dollar on dollar. And it has no bearing on, crypto asset prices have no bearing on this product or these yields. So your assets that are being collateralized are just hardware assets that are earning cash flows from, whether it's telecom towers, energy PPAs, GPUs, these are just businesses that earn cash flows. But because they're earning through DePIN networks, they're earning them on chain. And so you can basically pair a crypto native financing solution with crypto native cash flows, and then roll that into this yield bearing product for users who want to get, mid-teens yields on dollars, basically.
Yeah, let's talk through, and this is an exercise we always used to love to do at BlackRock. Talk to us a little bit about the life of either creation or minting of one of these assets, and kind of how it works from the DePIN side to the assets underpinning it to actually, being distributed to an end user.
Yeah, so I think it'd be good to maybe give some context on why this is relevant. So we've been, this company, USDAI, was previously called MetaStreet. We started it in 2021. And we have a background in structured credit. So my personal background's in investment banking, private equity. In 2021, we saw what was happening in crypto markets with things like Uniswap, Aave, 0 to 1 moments in financial innovation, right? But those products are all kind of focused on money market-esque asset types. So, tokens most closely resemble currencies or stocks, and the products that were servicing them were servicing liquid asset types. We kind of envisioned that there would be a traditional debt market corollary to on-chain capital markets in the future, and that was basically what we set out to build. So over the last 3 years, we've done about 400 million in loan volume across a wide variety of asset types. And so that includes regular RWAs all the way to NFT art and collectibles. And for one reason or another, the collateral types have just never really been that great. In the RWA space, you oftentimes will have adverse selection problems where if you think about like why somebody might be trying to borrow against a piece of real estate on chain, most likely there's something wrong with it because there's a very robust debt capital market for real estate, right? So if you're coming to this sort of novel financing vehicle, there's a reason for that. And so even though we've been around for the last couple of years, we've always struggled to kind of find the right collateral pair for what we basically built and iterated on, which is this structured credit market. And so in the last kind of 6 to 12 months, what we realized was DePIN assets are actually the perfect asset-backed financing product for us to build around. And the reason for that is that DePIN networks, one, have very poor token models. So right now you have, this emission program where you will emit tokens and, try to attract supply to the network. That means that you pay out a bunch of tokens, which can be very expensive. You emit tokens, which can be very expensive. And then the DePIN network has this like collapse in token price. But the assets that are underpinning DePIN networks traditionally would be financed. So if you think about, just regular telecom businesses, these are CapEx intensive businesses. You would typically get financing on these. GPUs as well, neo clouds are all getting financing right now or actively trying to. And so these asset types that are earning cash flows on chain, but are unable to get financing because they're earning on chain, means they're kind of the perfect asset type to finance on chain with us. So the DePIN network is, if they have access to a debt market, the DePIN network has less pressure on their token price because they don't have to emit as many tokens because the users can actually, instead of putting $100 into a piece of equipment, they only have to put $30 in and borrow 70. And then the hardware operator gets to amplify their returns. Ultimately, the end depositor into USDAI also gets to participate in these cash flows and get exposure across all of these different DePIN networks, but not at kind of the token layer or not even at the equity layer, which are more volatile and more risky, but in sort of this asset-backed debt layer. And ultimately, you then as a user get to access these yields, which, not including any incentive mechanisms or anything like this, are pretty attractive yields. And so you get to bring kind of some credit into crypto that isn't there and ultimately access like a different debt capital market that you wouldn't be able to access otherwise with DeFi.
Let's talk about this from an example that people are likely familiar with. So let's take something like Hivemapper or something very akin to it. So let me guess that the Hivemapper dash cam might be on the order of magnitude around like $500. So instead of them shelling out the entire 500, they're able to actually get some better financing rates. Either from how would that essentially work? We don't have to use Hivemapper as an example, but it's the one that's the most common.
Actually, so I think this is interesting because Hivemapper and Helium and a lot of these DePIN networks, they typically will offer low cost hardware, right? That they're selling to consumers. And they're trying to get those consumers to put that hardware in their house or their car or whatever. And then you also have sort of the higher cost, higher fidelity hardware like GPUs, which for a server of 8 H100s is $350,000. And those asset types get like really high quality data value and data fidelity. So actually it's really interesting because in 2021, Helium was sort of the most well-known DePIN project, and they sold a lot of these nodes. And what ultimately ended up happening was the quality of a network you get when you're using kind of this consumer grade edge hardware is a lot lower than what you really want to create a valuable network. But because they're trying to, get decentralized coverage and sell to consumers, and consumers can't afford to put up lots of capital to, buy these big nodes, nor do they have the operational know-how to do so, you end up with sort of a lower quality network that really only is valuable on the edge, on the fringe, not really competitive with any other telecom network. And we want to avoid that design altogether. And this is really what's happening in DePIN today is DePIN networks are selling the economic interest, but they're keeping operations centralized with the main team that's running the business. And then they're just using the crypto piece to have decentralized economic ownership of the network. So you sell an NFT, that NFT, it represents one node in the network, and the actual node is operated and managed by the actual experts in operating and managing these things. And that means that you can have democratized ownership of the asset and democratization across the cash flow layer, but you don't have to be kind of operationally intensive in that regard. And so this is like basically the progression that we see happening, which is really great because when you have sort of just this on-chain representation of the asset, you can finance with us very easily. And so the underpinning, mechanics of how this is all working is you have some asset that's being tokenized, whether by us or by the DePIN network, and represented with a 721 on-chain. That 721 has these rights to these cash flows. And so I can underwrite this from a debt perspective. And you can actually take that 721 and post it as collateral in these pools and borrow money out of the pools. And so that's like, basically the direction that I think we're going. So it's less likely that we will be supporting sort of $500 consumer grade equipment, right? Because also there's less of a reason for you to finance something like that. It's just not that expensive. You probably just don't need it. But when you're talking about, solar panels or these like $50,000 telecom nodes or, electric chargers, which we've seen a lot of lately, Tesla superchargers, which are $150,000 a pop, or GPUs, you start getting into the math very quickly of like, hey, I don't want to make a cash outlay of like $200,000 for this. But if I can borrow against it, now I, as an individual, could basically be a participant in this network, get these great returns, and never really have to be like operating or coming out of pocket like tons and tons of money.
So who is, I guess it's always tricky to ask this question because everything is a multi-sided marketplace in crypto. Talk to us a little bit about like, who is the ideal person? Is it still me because now I have these financing, or is it still retail as like I have these financing options? I actually could, invest in this, or is it like, hey, I would really only use the underlying stable coin? Like, talk to us a little bit about like who is the actual consumer.
Yeah. So, it can really be a wide variety. Like once the tokenization occurs, you can kind of, whoever holds that asset, I don't need to know who that person is, right? Because you're just posting this asset permissionlessly into this pool as collateral. But I can say that in our conversations with the borrower side of the pipeline, it's largely, well capitalized neoclouds who've raised, 10 to $50 million to buy GPUs. And by the way, like if you just think about that example for a second, if you're a startup and you've raised 20 million bucks and you're going to go buy hardware with that for $20 million that depreciates in 3 years, like that's a pretty poor use of capital. But that's what they're doing. I mean, they're not really able to access financing on this stuff largely. But I would say that the borrower side is primarily, at least semi-sophisticated participants. I do think that a lot of the DePIN networks will end up selling NFTs that represent the nodes in their assets, in their network. And that participant could then be a smaller retail participant. But from my perspective, most of the retail participation will be more on the deposit side, where you're basically getting access to, all of these different DePIN networks and all of the hardware underpinning them, all rolled up into this single token that you can just mint and redeem at will and, earn cash flow basically.
Got it. And then I remember reading, and maybe I'm incorrect on this, that there was something called a DePIN Trilemma. Would you be able to expand upon what that is?
Yeah, so we kind of touched on this, right? It's like you have price, data fidelity, and reach. And these are kind of the three levers that you can pull as a DePIN network. And so as you go down the price scale to get more reach, your data fidelity decreases because you're, again, like edge computing,
Yeah.
low value inputs equals low value data collection, low value outputs. And so the way that DePIN networks try to solve for this is just throw tokens at the problem, right? And then if you pull up any DePIN, token chart, and they're basically down only. And the reason is because they're front loading all of this supply to try to attract the supply side, when in reality, it's sourcing the demand side that's the most important thing. But you've just spent all these tokens to attract supply, and you're basically just renting the supply, right? As soon as those tokens go away, the hardware goes elsewhere to make better returns. And so the way that we think about this is basically, if you can introduce a financing layer for the hardware itself, you lower what the emissions need to be for the hardware operator to end up making money, right? Yep. Because if you are making a 50% APR on your hardware without leverage, then you get to borrow 70% at a 15% APR. The beauty of leverage, like now you're back up to a 50% yield, but you only needed a 20 or 30% native yield. So that means that the DePIN network can pass out less emissions, which ultimately should mean that the token is more valuable. They can add more demand to burn the demand side, and ultimately actually scale these networks. And it's not a novel concept. Like what we're talking about here, if you look at any, AT&T, any big infrastructure company, they're very, very much financed with debt because these are CapEx intensive businesses that have fairly stable cash flows. In the case of electric chargers, these are charging stations that have almost completely certain cash flows for the next 10 years. When you have that cash flow profile, you're almost always financing that because the debt underwriter can look into the future and be comfortable, with what they're participating in that case. And so that's kind of how we think about it. I think this is a much needed product for any of these DePIN networks to succeed. And if you really want to think about the first DePIN network ever, it's really Bitcoin, right? Like Bitcoin is hardware network that's mining a network token. And when you introduced debt for the Bitcoin miners was when we actually first started to see a less volatile Bitcoin chart, because the Bitcoin miners weren't forced to sell tokens every month to cover their operating expenses. They could end up balance sheeting a lot of that and reinvest some of their dollars into new miners or expanded operations or whatever. So it's a natural progression for these industries. And it just hasn't quite gotten there for this industry yet, but we're thinking that this is like the natural progression for all of this stuff.
And you mentioned a few different kinds of underpinning real world infrastructure. Is there a specific vertical? Obviously AI is in the name, so I assume it's GPUs. And so talk to us a little bit about what are the underlying assets, and do you plan on expanding those?
Yeah, so any physical infrastructure assets that earn cash flows on chain is really where we're focused. And the reason is because as soon as you start earning cash flows on chain, you preclude yourself from traditional financing sources. You can't really go to a bank and tell them that you're mining a DePIN network and ask for a loan against that asset. It's just unlikely to happen. So these are the categories. So right now it's telecom, compute, and energy. And these are kind of the three categories that have the most expensive hardware networks for these various DePIN projects that exist today. And for each of these pools, we actually have vault managers. So you can think of this similar to Morpho, where you have a vault manager who picks a strategy for people's capital. And we have something similar here. And the vault managers are less crypto native than they are asset native. So the vault managers for the compute strategy are going to be very different from vault managers for energy or telecom. They're really just supposed to be expert underwriters for these assets, so that we are making sure that these are well capitalized loans and not going to go underwater or things like this. So the vault managers will actually take a first loss position in the pools. We think about all this in terms of levels of defense. So for every loan that exists that's underpinning USDAI, you have an equity layer, equity cushion that the borrower is sitting in. So for your $100 purchase, you have $30 of equity. And then you have a first loss position underneath that, which is the underwriter. So if there's a default and the assets are sold at a loss, the underwriter will be the first loser before anything hits the USDAI backing.
That makes complete sense. And then talk to us a little bit about like what stage you guys are at, like what's the adoption?
Yeah, so we're going live May 15th, I believe, or mid-May. We've, this infrastructure has existed for a while, but retooling it to launch the synthetic dollar product, that should be in, May 15th. I would say on the borrower side, we have well over hundreds of millions of dollars of borrower demand right now. And then on the depositor side, probably have earmarked somewhere around 100 million of deposits, give or take, with just early conversations we've had. So that's our expected, next couple of months, basically.
Very exciting, very exciting. And then talk to us a little bit about what you guys have done to, or like what you've done to bring this to market. I'm sure because it's a multi-sided marketplace, like you've got to deal with DePIN networks, you've got to deal with people that are looking to, invest in the different pools. Like what's that been like?
Yeah, so it's all just a cost of capital game, right? Like from the borrower's perspective, they're just asking, is this accretive financing for me, right? Like, can I make more money than I owe in interest on these loans? And do I have alternative sources of capital that are cheaper than this? And I can say, so, we expect mid-teens yields on this product. CoreWeave, which is one of the largest neoclouds, did a $7 billion loan with Blackstone. That was at SOFR plus 11, so 16% cost of capital for a chunk of $7 billion. So, cost of capital wise, we're pretty competitive, I think. And then, the rest of the questions are just around, when you look at the lender side, what else can you get in crypto? Like if you're someone who's doing a delta neutral strategy in crypto, what are your alternatives, right? And you have something like the basis trade, which when there's not a lot of volume is not that great. It's, mid single digits. You have 1 million projects that are selling T-bills. So you've got a 5% yield there, right? And then you've got what else? I mean, you have, Uniswap LPs, which have tons of impermanent loss, almost never have positive expected value. You've got stuff like Aave, which maybe occasionally will bump over 10% when there's a lot of demand, but generally, mid single digits as well. And then you go out the risk curve, and then you've got crazy farms that, again, no native yield. I think it's just, that's really the kind of pitch here, is that the native yields are mid-teens. It doesn't require us to have crazy token incentives or anything like this. And then you have confidence that your underlying assets are actually real physical assets that do exist, that are tokenized. And, when we do this tokenization process, all of the assets have to be sold into Permian Labs, the Delaware C Corp of USDAI. So that asset holding is then insured with a master insurance policy. So that means that, if there's a default and you have an auction that sells on chain, your buyer is buying, really has complete certainty that what they're buying is actually backed by the value of the assets, right? Because you have this master insurance policy. So you kind of wall off like a lot of risk profile, and then you say, for mid-teens returns is pretty attractive. And those are the conversations we're having with capital sources on chain. And I would say generally, like people seem to like that kind of profile of yield.
Yeah, I'm absolutely sure of that. So finally, where can people learn a little bit more about you? Where can they learn a little bit more about USDAI?
Yeah, so the website is literally usd.ai. Good domain name. People can go there, check it out, see all the docs, and protocol should go live in a couple of weeks, like I said. Twitter at USDAI_official. I'm sure we'll have show notes with all that stuff too. But yeah, generally we're around on Twitter and Telegram. And
awesome. Well, I'll put everything in the description. Everyone go get involved with Conor, go get involved with USDAI. And I look forward to speaking with you all again soon.